of the base you've got and build on it in a bigger way. So that way you won't get bored, right? Appreciating that? I didn't think so. I feel your pain. Okay, so let's go through Chapter 6, Revenue Recognition. So, as you learned in intro, when you've done the work, you can record your revenue. The problem is, how and when do you record the work as being done? For example, if you're doing a long-term project, especially when it comes to the year end, when can you record revenue? Or if things are in shipment between places, or if, which of course you determine by free on board, whether it's at ship receiving, and things like, well, not only sell them the product, but you've got a 2-year warranty you have to deal with. That can't all be recognized as revenue right when they take it home. So that's what we're going to be looking at, and hopefully it'll make sense. So, accounting for when revenue should be recognized on your books as the seller, it's complex because of the structure of sales transactions. So it's not clear-cut as it was in intro. It becomes a question of what is given up and what is received in return. And you can read and review the following items in your text. Other revenue recognition issues. Learning Objective 9, Gifts Card, which is example 6.21. I'm going to go over the bigger ones that kind of give students the most problem and grasp all the pieces. Okay, so sales actions, of course you can read along with me, often involve transfer of goods, services, or both. Okay, and those are all known as deliverables. So if a question, the deliverables are, that's what they're talking about. And the accounting is slightly different under each situation. So we're going to try to get you in a pattern of 5 steps so you can, okay? So, sale of goods, tangible assets with a finite point when control transfers to buyer. So, that's usually pretty straightforward. That's what we started you with last year. Sales, legal title, and the possession is relevant. It's when you have to it. Sale of goods and services combinations. That's where the complexity comes in measuring each component of what's called bundled sales or multiple deliverables. So you're selling something with a warranty. That's 2 things. Part of it's a sale, part of it's a service, right? That would be one of those. Now, most business transactions are reciprocal, so something is given up, something received. And consideration being received for goods and services is either cash or cash-like, some kind of monetary thing like AR, or non-monetary. So another good or service, also known as barter. Okay, now remember, tax rules are often different than accounting rules. Talking about accounting rules, whether tax wants you to measure your goods given up as barter at fair value and compare that, that's a whole different thing. We're not worrying about tax. We'll let Michelle and Greg and those guys deal with that. So generally assume the transaction is at arm's length between unrelated parties. So think of it, I know students sometimes get confused at this, especially when we get to the assets chapter. At arm means they're far away. They're at the end of your arm. So it's like they're unrelated. Okay? And deliverable sold is equal to the value of consideration received. So we're doing the straightforward ones. Now, sometimes differences in sales give rise to more uncertainty. For example, are the terms of the sale kind of normal, or is this a special deal? So, concessionary items are terms negotiated to the contract that are more favorable than normal. Okay? So it might just be that they're a big, powerful customer, and you really want them to buy from you. So they may create additional obligations like a right of return, where the customer can return things for an extended period of time or something like that. With additional obligations, it may indicate that control has not passed to the buyer. Yet we sold them the goods, they took them, but they have 4 months to return them. That's kind of a time. Well, I shouldn't say that. In some circles it is. If you're thinking of planes, you probably got a longer time, and if you're thinking of groceries, you have a shorter time. Or if you're Costco, take anything back, don't they, for 30 days or something? Maybe that's just the States. Anyway, I never go into Costco because I spend all my money. So, okay. So, if control hasn't passed to the buyer, can we write that we've earned the revenue? No. So there's additional recognition and measurement risk which we have to account for. So ASPE uses the earnings approach, which is pretty much what you've gone through in intro. So revenue for sale of goods and related costs are recognized when there is a change in control for seller to buyer and all the following conditions are met. So the risks and reward of ownership have transferred to the customer. Forks are halfway across the Pacific, and it be, oh, I always get those backwards and I don't have them in my mind right now. It's FOB, and the rights and possession of the goods have passed to the buyer. So in that case, if there's goods floating somewhere going or coming on its way to Canada, if the risk has transferred to the buyer already, the buyer is responsible for it. On the other hand, if it's the other way, the other party would record it in their books. Okay, so if the risks and rewards of ownership are transferred to the customer, if the vendor has no continuing involvement nor effective control over the goods, costs and revenues can be measured reliably, and collectability is probable. Okay, so in intro, when you talked about selling something and when you can recognize, we always assume collectability is probable. We're not talking AR, because in AR you can make AFDA and get an approximation there. This is more, say on a big order to a new customer, or there's been major changes in the economy, so hit the whole world. Improbable, and we have to put off actually recognizing the revenue. So, in an example, in the classroom, in real life, you'd know because your business circumstances would be being changed. But in an example, it would have to say collectability. Assume it's probable unless they tell you otherwise. So assume collectability unless told otherwise. Okay, now that was ASPE. So IFRS standard is different. It's IFRS revenue from contracts with customers. Now, we said once you get out into the actual accounting world and the CPA, if you go on, you're going to have to look up some standards. Because let's say you get a situation that's new and you're not 100% how to handle it. Well, if it's new, everybody's new, you got to figure it out, right? So think of it as law. If you're a lawyer and some new law came out, you'd have to look it up, see how it fit to your case, make sure you were anything. Same thing with this. Okay, so IFRS, if you look up in your handbook, and at the big, I think I gave you instructions how to access it. In your course outline. You could look up IFRS 15, and I really encourage you to do it, especially if you want to go on to CPA, because is the open book part of your exams. They give you the handbook. So something up. Or they give you a new situation and make one up you've never heard. You can look it up and go, oh, this is how I treat it. So very good to look up. So it adopts an asset liability approach or contract-based approach for the basis of recognition. It's all about what the contract says. And they measure changes in assets and liabilities. On page 2, these are really the key objectives, and this is illustration 6.2. Key objective is to recognize revenue to depict the transfer of goods or services to customers in amount that reflects consideration the company receives or expects to receive in exchange for goods or services. So it's similar to ASPE, but really they're looking at what does the contract say. So what are you responsible for as a seller? So the 5-step process, and we'll be doing this with 2 of the examples so you can see how it works. First, you identify the contract with the customers. Who do you have it with? Maybe it could be 2 different parties, that kind of thing. So you identify it. The second is look at the separate pieces you need to do in the contract. Okay, so there might be multiple pieces. We've got to figure out what the actual price is overall, and then realize that whole price needs to be allocated to any separate performance obligations. So just to keep it simple, you've got a product and you've got a warranty. Well, some of it's going to go to the product, some of it's going to go to the warranty, your revenue. You'll have 2 kinds. And then you recognize the revenue when each performance obligation is satisfied. So it's kind of logical and straightforward, unlike sometimes with accounting, but I find it helps students when you can do this, when you're starting to get confused about what you're dividing this up into. If you've identified what do we have to do for them, well, we have to first sell them the product, we have to install them, we have a 1-year warranty, and then we have a 2-year warranty after that. So then you notice it would be 4 pieces. Okay. So the key thing is we're still recognizing revenue in the accounting period when the performance obligation is satisfied. So it is similar to ASPE. It's just think of it as pickier in terms of breaking the pieces down. Okay, I'm going to pause here so I don't run over my time for my recording, and I will see you on